Okay, let's get started. The rest will join. Let them join later. If not, we might not have time to go through all of this. Yeah, we start from the first one. Correction for tech stonks incoming. Anyone? I ask anyone ask these questions in the group here. So I think no response. But anyway, I'll just give my response. See if you guys have any feedback or not. So in my opinion, not going to happen soon. So, especially we look at the momentums, right? It's still strong. If we just look at it from a macro perspective, yes, tapering is happening already. It will take, let's say, 6 months for them to end the Fed bond purchase, right? The QE. Then usually, right, if there's any pullback, right, it will be lagged by, I don't know, like maybe 6 months to 1.5 years time. So it is common for this to lag. If you just look at the previous Fed tapering, right, it's not like they announce the stop of the tapering, then start where you see a correction, right? So it will take time for the market to adjust, and then the yield will slowly rise. And then to a certain extent, people will start to worry about. And then when the bond yield is high enough to attract monies to flow into bonds, then there will be some corrections, right? But within the tech stocks component, I would say we cannot label everything as tech, because for big caps, right, for example, like Apple, Amazon, Microsoft, Google, these are one group, right? These are the tech stocks that have very high earnings. But there are also the rest, right, which is very high valuation, cash burning kind of tech stocks. So I will assume that, let's say if there's any correction, right, those without strong earning, without strong cash flow, those will experience a more drastic drawdown. So in the scenario of if we have any market correction. But I'm not expecting one coming soon. We should expect it will come eventually. It could be this week, it could be end of this year, it could be next year or the year after, we don't know. So for me personally, I won't try to time the market. I will just stay invested. But let's say at this valuation, I will try to keep my leverage low. I'm not the type of investor that will say, okay, let's do 50% leverage, and because I don't expect correction coming soon. So that's just from me. Any other one? Anyone else has any to comment on this first question? All right, no comment. Let's move on. Hey, this is not pass. Okay, never mind. We just go to the next one. Outlook for Nvidia. I'll pass this question. I know who will comment more on this. YCX, this is your turn. But we see if anyone have comment first, then let you comment later, YCX.
Okay.
I think no comment. You just go ahead.
Outlook, simple summary is that I think you'll go to 1,000 in probably 2 years' time. Yeah. Right now it's 330. You'll probably go to 1,000 within 2 years' time. Or 2 or 3 years' time, you'll go to 1,000. That's
But
the outlook on it.
Why such a high price
The
target?
why I'll leave it to later, because I actually later on I'll share with you all something that will cover why it will happen. Yeah. Yeah, because if I say it now, it will be quite confusing. So I'll leave it to later.
All right, sure. As for me, I think Nvidia's fundamentals remain strong. Their business in data center, all these are all doing well. But just bear in mind that, okay, the growth of the fundamental, I think, will be solid at least for the next, let's say, 1 to 2 years. Just judging from the product that they are launching, the services, and their moat around the business. So I'm not worried on that. And somehow with all these chip shortages, right? So I expect that there's a lot of supply that actually got pushed back, meaning that they're not able to meet the demand, right? So if the demand get passed on to coming quarters or coming years, right? That only will tell us that, okay, the growth will remain strong. We're talking about like coming 1 year. But after that, we don't know, right? Hard to say. That's one thing. Second thing is that valuation is really quite high. You just look at their earnings, cash flow versus their market cap, right? So this is not a cheap company. So if you enter now, I would say that just be careful. Don't say, okay, fundamental strong, how come the share price will drop, right? I mean, given the valuation so high, and any volatility around it should be expected, right? So this is not how to say, just be ready lah. I can't say that it will be stable like this, and trading activity usually will lead to volatility of the share price higher than the volatility of the fundamentals. So that's my comment on that. Let's move on to the next one. Let me read it out. Usually when there is a sharp continuous rise in the share price, it will be followed by some correction. Do you think Nvidia price will correct in the near future? I think I just comment on this. I got nothing more to add. Anyone else want to just give some comment on this?
I mean, correction, this type of thing, no one can predict because it really is. If you want to go into it, then you have to actually study on like things like market structure and market profile, and that one is more of like even for people doing that is a very it's kind of like a hit or miss thing that most people don't get it right. I mean, it's probably a 60% chance to get right, that kind of thing. So yeah, a lot of it is just they are trying to justify a narrative for pullback or whatever thing. So it's very hard to tell. Yeah.
Yep. Yeah, I think what we are advocating here, right, is just like pay attention to the business and not so much on the share price, right? So I think in this sense, right, the DCA approach really helps. So even if you want to invest, you are worried on the pullback or correction, just invest a little bit so that if the share price drop, you can still buy at a more attractive price, right? And if it goes up, right, then you also have some gains already. And as long as the business doing well, just average up. So I don't see any concern on that. Okay, let's move on to the next one. How come Shifu so handsome? Okay, I'll just pass this one. I think it's very funny. I don't know who asked these questions. Next one. How come corn should I? How much corn should I buy to protect myself from inflation? What if there is a conflation? Then what should I buy? Who's asking these questions? So can you please like give a bit more, like elaborate a bit more on the questions? All right, no one. How much corn? Let me comment on the inflation part. So before that, I just want to explain the corn here. This is not the corn that we eat. This is the Bitcoin that we are referring to. I don't know why Bitcoin and corn is the same thing, but this is how it is. But let me comment on the inflation. So I don't think Bitcoin is a good inflation hedge, especially if you look at it over, let's say, a short term. Let's say if you do a correlation kind of analysis on crypto or Bitcoin versus inflation, right? Because the Bitcoin itself is so volatile and you don't have a good hedge using Bitcoin. That's over a very short term. Plus, the Bitcoin is very volatile. Let's say if you buy, and by inflation, what we usually means is that you want your capital or you want your investment to be in something that can preserve the real value, right? But the Bitcoin price itself, because it's subject to speculations, so it can go up 20, 30% in a day, right? In that sense, it is not a good inflation hedge, especially over the short period of time. But let's say over longer period of time, let's say we are talking about 10 years, 20 years, right? I would say that because Bitcoin itself, it is, how to say, it's actually, you should see it as a currency more than something like an investment, because Bitcoin itself is not it's not productive, right? They are not producing anything. They are just like a store of wealth or store of value. but an instrument that is very volatile. But given that if we just compare fiat versus Bitcoin, given that Bitcoin is scarce in nature, right? So I would expect that it will hold up the real value better compared to fiat currency. So that's one point. But whether Bitcoin versus, let's say, equities, whether it's better or not, then we need to bring up the whether it's a productive asset class or not. I think that will be an argument to say whether it is a good inflation hedge or not. So I think that's my comment on that. The second part, I actually not too sure what does this conflation mean. I'll pass to YCX. I think you will have more opinion on this.
Conflation in the sense that the max supply of Bitcoin is 21 million. Every day there's 900 new Bitcoins being minted until 2025 or something. Yeah, 2025. Then after that it will be 450 Bitcoins minted per day, and so on. Every 4 years it cut it in half, so it'll be 225. So you can kind of see that the number of new Bitcoins entering the system, right, of which it will end in 2140, which is 21 million. The number of Bitcoins right now, 90% of the supply has already been minted, or close to it, close to 90%. By December, by Christmas, it will be 90% already. So it is actually a monetary policy. I mean, if you look at Bitcoin as a form of currency, right? And again, currency itself has no intrinsic value. Currency is just propagated by its network effect. That means the more people using it, the more network effect it has, the more prominence it has. Uh, and the monetary supply itself, the monetary policy itself, the supply is a disinflationary monetary policy, which is to say that the inflation of it reduces over time. Yeah, so that's the meaning of it. So a lot of people say that Bitcoin is deflationary or whatever. It actually doesn't make any sense because miners are still mining and 900 Bitcoins are being minted every day. It's just that the stability of it from a minting aspect, everyone knows it's going to be 900 coins a day for the next three and a half years more. Then afterwards, everyone knows it's going to cut in half that supply. So that's the meaning of it lah. Okay, I mean compared to other currencies, or I mean even if you just compare to Dogecoin or something, Dogecoin has a policy whereby the inflation is constant rather than disinflationary, which is to say that there's a fixed amount of coins being minted every year. Yeah, so that would be like a constant inflation. So you can call it as like a fixed inflation in the sense. Then when you compare it to like more traditional, I mean, I wouldn't even call it traditional because it's only been around for the past 100 years. So but in this sense, traditional in our young lives, the fiat currency, the inflation rate is actually unknown because the central bank can decide to print money or to destroy money at any point in time, and they don't actually have to announce it. They can say it, but it's always an estimate and you never know it until it happened. Yeah, so unless you are up there high in the ladder of the or I mean they call this the Cantillon effect. Unless you already know that the money is coming in and it's coming straight to you first, then it's quite hard to know what exactly is the inflation, the real inflation rate of fiat currency. So that's about it for in terms in terms of the fundamentals of currencies. Yeah. The rest of it, whether like Bitcoin will go up on inflation or not, this one is more about like expectations. And if we draw a correlation with gold itself, gold during the 1930s all the way until 2000s, the price of gold is actually people say, right, I mean people right now say that gold is a stable hedge, but this stability of gold only happened in 2001 after the ETF was introduced. Yeah, and as to why I won't go into that. further, because that is more about like market manipulation kind of territory. That, yeah, if you're interested, you can look it up yourself. But in terms of um how to say, inflation hedging, right, is more about expectations. Yeah, yeah, all there is to it. Because if you look at it, gold itself is also pretty useless. I mean, people say it's used for jewelry and electronics and things, but actually the amount that is used in that is actually very little. Yeah, there's a lot of supply of gold going around actually. Yeah, so that's the take to that lah. Mm.
Okay, thank you. Let's move on. Actually, I don't know how to operate this. There's new questions that pop up. I'll just go through it. Try my best. Okay. What? Okay. Let's go for this one. What is your opinion on mutual fund versus ETF? Why insurance agents keep trying to sell mutual funds? I think my first reaction is that if you want to invest in a diversified instrument, right? Given that nowadays, I think most of you already have, let's say, Tiger, Interactive Brokers, or Mumu, right? Or even Robo Advisor, right? I think just buy the ETF is good enough, lah. Just don't bother with the mutual funds, unless you are investing your SRS or CPF, those that really have limited choices, and you have to go into mutual funds, then also okay. But let's say if you just want to invest in like a passive instrument, right? ETF itself is already good enough. And then let me comment on the second one. Why insurance agent keep trying to sell mutual funds, right? I would say, mutual funds, I think most of them either sold by insurance agent, or it is sold by, let's say, those sales agent working for mutual fund companies, right? They this is how this is their work, right? So their job is basically selling you mutual funds, and then they will have some commissions, right? So I think this is how it is. So how much you put into the mutual funds, there will be a small percentage that will get paid to the insurance agent, or the mutual funds agent, and then but in a sense, that small fee, that small percentage that you pay, right, is kind of service, right? For example, if you are not investing the money yourself, you need an agent or advisor to help you, right? Then I think it's their job to actually advise you which one to buy, and then try to understand the funds. You have any questions, you should ask the agent. This is their job, to educate you, to provide you with some good information. And then in return, you buy through them, and then you pay them the fee in terms of the commissions, the small percentage commission, right? So that's one way to do it. The other way is you just do DIY yourself. Basically, like us, right? We use ETF, and then basically you don't buy through any agent. You can just read it up yourself. So that's something that I would advise. But I just want to explain like why even now with much cheaper ETF, why this mutual fund industry or insurance agents, insurance industry is still around, because not everyone want to do the DIY, So there's value add that they can provide. That's why they will still exist now and in the foreseeable future. Okay, that's all comment from me. Anyone else want to add on to this?
I think
Yeah,
for mutual
I
fund,
would say that um instead of looking at like whether it's mutual fund versus ETF or this kind of things, right? It's more important that whatever that they are selling you, or whatever that they're pushing for, or whatever this kind of funds that you are looking at, that you just look up on the internet what exactly is the fund's mandate. Because once you read the fund's mandate, that means what exactly is doing, right? Then it becomes more clear, that okay, so this fund aims to do certain stuff. What are the objectives of this fund and things? Then you can look at each of the funds individually, and then you can look at like the expense ratios, management fees, or look at that all individually, and then you can work out your own calculations. I think that is more important, rather than just having like broad classes that says, oh, mutual funds versus ETF. Because a lot of all this is basically there are ways for people to actually do accounting trickery, so that they can actually like save on certain things or get past certain mandates and stuff, whatever things that the government has set or whatever stuff. So just look through the different mandates first and see what exactly they are doing, rather than compare them directly.
Yep. Eddie?
I think the other reason is like why I invest in some mutual funds is because, like, for example, like Money Hour, they got the dimensional funds, which you can't get elsewhere. Then the other type of mutual funds I invest in is those that there's no corresponding ETF. I mean, broadly speaking, mutual funds, they follow an active strategy. So if you believe in the active strategy and you cannot find a corresponding active ETF, that's why I invest in some mutual funds. So, like, for example, those China high yields, unit trusts, those I'm getting like more than 10%, more than 10% yields because of the current pricing right now. Yeah, so that's another angle to it.
Yeah, I think that's a good point because traditionally mutual funds, they are all managed by professional. It's an active strategy. And traditionally, when the ETF came out, right, it started out as usually like a passive strategy, but now it's getting a lot more like mixed because within the mutual funds, since the bogus time, I think already have a passive mutual funds. And then in the ETF, for example, like the next question that we will address next, right? Cathie Wood ETF. This is ETF, but it is active fund. So you have like 2x2 quadrants. You have mutual fund ETF, which actually tell us how the fund is structured. And then you have the active versus passive, which is how the investment strategy is done. So, but usually mutual funds we are referring to active, and ETF we are referring to passive. So that's a good point. Just pause a minute, see anyone got anything to add or any follow-up questions. All right, then go to the next one. Let me read it out. Do you think Cathie Wood is a troll? Her ARK ETF has been sliding in 2021. Let me explain a bit on the price movement first. So I remember end of last year or beginning of the year, ARK ETF. I mean, that's when Tesla price shoot up a lot, and then Cathie Wood is like very suddenly become much more famous, right, compared to the past. And then I see that there's a lot of hot money flowing into first flowing into ARK ETF. Second one is that even those who don't invest in her ETF, right, they are actually following Cathie Wood's trades. So, you know, they send out like a daily trades, right? They sell, buy, sell, they just inform anyone can check out their trades. And then there are many traders actually following her trades. So just in general, like whenever a investor or fund managers that had a huge returns, then for sure people will chase the trades or the portfolio. But usually this one, it will not last forever one. So it will cool down, and then once it's cool down, right, when those hot money like traders, they just keep chasing, and then they don't see any returns, right? Then they will just say, okay, Cathie Wood is a troll. Cathie Wood is not a good manager. Then why not I just chase the next hot the next hot managers, right? So once money flow out from this investment, right, then that's when her ETF performance will struggle, and then her portfolio companies also will also struggle. In fact, if you look at even Tesla, right, from the early of the year until like mid of the year, I think it dropped quite substantially. It's only the recent 1 month or so after the Q3 earnings report, it started to pick up again. But others, right, for example, like Roku, Teladoc, all these names actually not performing well. So my answer to this is that no, I don't think she's a troll. I actually think that her investment is quite sound in the sense that paying attention to the long term, focus on those destructive technology. I think these are good strategy. I'm not saying they are bad, right? It's a good one. It's just that if you invest with her, please be aware that her strategy, right? I don't think she cares so much about the valuation. So like Tesla price shot up so much, she don't have a problem to buy. And then second thing is that the companies that she invests in, right, are most of them are actually not generating profits and not generating cash flow. So whenever, like, let's say tapering or any macro stuff happening, right? If there's correction, I would expect that her holding companies will drop more than the other companies, right? Because you don't even have earnings to support, right? So just be aware that the ETF is riskier than the broad market. But definitely she's not a troll. I think it's not fair to say such thing, right? Because she's just investing her money, and then all these ARK ETF prices or her holding companies' prices, right? These are all affected by a lot of other factors. For example, like these traders, right? So I don't think you shouldn't judge her 1 year performance and say whether she's a troll or she's good now, because it's very much affected by the flow. Not so much on her strategy. You really need a longer period, like 3-5 years at least, to say whether her strategy is a good one or not. I'll stop here just to pass around, see if anyone got anything to add. All right. I think this week a bit quiet there. Why is it so? Like, I think previous week we have a lot more other comments. Just let me know if you have any comment. Just voice out. Yeah, just unmute. We'll give chance. And if you have follow up questions, also feel free to chat. All right, let's move on to the next one. At what age did you start investing? Okay, I think this question is for me lah. From what age? Actually, let me share some story lah. I think my first investment, I don't remember when, but it should be around, let's say, 15 years ago. Yeah, let's put it that way. 15 years ago, I was, maybe even 20 years ago, I don't remember exactly. I was investing in a company. It's a Malaysia company, AirAsia. I guess you all know lah, for those who's traveling. And at that time, I'm not investing my money. It's just that I'm looking at the newspaper, and then, like those newspaper, they have lists of stocks with some key measures, right? Like all the 52-week high, 52-week low, the PE, the share price, all these things. And then, yeah, I think that time my dad just saw that I'm interested in looking at stocks, right? And then he just asked me like, okay, do you have any companies that you want to buy? And I know nothing at that time, right? So I just look at the list of stocks, and then I just look at the PE lor. And that time, AirAsia PE is quite low. Then I don't know I know it's airlines at least, but I don't know the details like financial statement, those kind of things. And then I just said, okay, then just invest in AirAsia. And then I think my dad sponsored me lah. I think it's like we put in like 2,000 ringgit into that stocks and then it's not even in my account, right? Because I was still I think not even 18 years old at the time. Then we invested and didn't monitor that closely. And I think after that there's some scandal around their accounting, and then the price kept dropping and dropping and dropping, and it dropped until like become, I think the worst point was around say 70 cents or 80 cents. So I lost like maybe 60-70% of that amount invested. Then I wasn't that sad or anything like that because I wasn't monitoring it closely lah. And I remember I had this follow-up chat with my dad, and then he said, let's just buy more because it's cheap, right? I mean, it sounds so noob, like, but then he put in like, I think another 10,000 in, like just throw 10,000. And then after some time, we also don't really follow up closely. That time is not like now we have an app on the phone and then we just everyday check on the prices, right? It's just like, I think we just have to call the brokerage to do the purchase. And then I think after a few years, I just realized that, okay, the price has shot up to, I don't remember exactly, like let's say maybe close to 3 ringgit, right? And then it's just turned out to be like, okay, investment that made money. But I think this is not a good example to say this is a sound or correct way to invest, because I didn't really follow up with their fundamentals, those kind of things. It's just that we buy and then look at share price drop and then we just add on. And I think some time around few years back, I already liquidated the positions and consolidate. So I no longer invested in that company, but just something that I started earlier. But for me personally, I this portfolio that we are talking about, the interactive broker, I started end of end of 2017. Yeah, but I think the bulk of the growth of the portfolio actually is in last year and this year, 2020 and 2021. And if you look at the stock market, you will know, right? This morning, just check, S&P 500 went up by 50% in the past 2 years, right? So that actually helped a lot. So yeah, I think I will stop here. If not, it will be a two solo talk. Or you have any questions on this? If not, I'll move on. Okay, let's move on. Which month of the year is correction most likely other than September? I would say these are all noise. If you pull out all the statistics, right, for sure, if you just average out in the past, let's say 30 years, right, and then you just tally, okay, every January on average, the return is how much, February, the return is how much. You just calculate the statistics, right? For sure, you will see that there will be some month that the return is higher and lower than the other months. It will not be totally flat, right? That's for sure. But then I just don't think this kind of statistics will help us to tell, like, okay, the correction will usually happen in which month. So the reason is not saying that statistics are useless. It's just that there's so much noise in the data. And then even if you look at the average return in certain months is higher or lower than the others, right? It will be override by the noises, you know. So that's why I would say just DCA. And whoever tell you that, okay, September is the month that you should sell in May and go away, those kind of things, right? I would say it's really stupid to follow those kind of advice. So I have a very strong opinion on this. Don't listen to that kind of advice. Every month is the same. If you put your money in the market, please be expected that just the next month, it could be a correction already. Market could crash already. So invest money that you have. Don't over leverage. And don't try to predict when the market crash will come. It will come for sure. We just don't know when, and we don't know how steep it is. I'll stop here. Anyone else want to add this? Yeah, go ahead.
Yeah, I mean, if you sell, if you need the money, then and you need to sell, but you don't feel like selling, then you just sell a call lah. Then you get the money. Anyway, it's a covered call, so if it hits, it goes up, you get a bit more lah. If it shoots up all the way, then that's too bad for you. You can take it as you committed to a sell already. That's how I look at it lah. And you just sell a covered call is very low risk. I mean, if you need just a bit of money and you already have the stock, that's what I think lah. Yeah lah.
Okay. Let's go. Go ahead.
I think I just Bunsong here. I just have a very short opinion on market crashing. Okay, so when you buy stocks, from my point of view, you buy stocks because a certain stock's valuation is good enough for you. You're happy with that valuation. So when the stock market drops, right, crash, and general across the board, there's a 20% markdown in prices. The thing is, it doesn't mean that you are wrong in your valuation. You have to understand that when the market drops 20%, a lot of times it's because fund has to liquidate. As you know, market movements are usually marked by institutions, or they call it whales. So you have to think that it's not your fault, and that is one way you can hold on to your stocks. Yeah, that's all I can contribute to this.
Yang, you want to comment? Just now you're saying something, right?
Oh, all right. A very short pro tip: don't read mainstream news for stocks. It is just noise and FUD and clickbait, because yeah, don't read mainstream news. And by mainstream news, I mean your mainstream CNBC, Straits Times. I don't know, in Malaysia you have Sing Chu, you have Dongfang. Here you have CNA, you have, yeah, whatever comes out on news is already either factor in, or it's just a very small part of the picture that doesn't paint the whole picture. What news you should read, you will ask, maybe some more professional sites. I would suggest Barron's is a good one. And yeah, I only consume Barron's actually for stocks.
Hi, Kelvin here. I would also suggest you read into those industry news instead of the financial news.
Yeah, I think that's a good one. I think on news, right? I would say financial news is okay to read lah. Not saying that you should avoid at all costs, right? But I would say the way we read it also you need to pay attention, because usually all kind of news is good if you just read for the facts. You know, you try to capture what are the facts, right? And I think quite a number of those facts you can verify one, right? But please pay attention to like what are facts and then what are opinions, because usually in this news, right, they will mix up the two. They will present you some true statistics, right? For example, Warren Buffett 149 billion cash not invested. Buffett decided to put in cash. Market is overvalued. You know, like those statements, right? You just look at it. I would say if you care about to know how much cash that Berkshire has, right? Then you read for the news, you saw the 149.2 billions. Who can say that is wrong, right? That is fact, right? You can actually verify it by looking at Berkshire balance sheet, those kind of things, right? So that is fact. But usually it mixes up together with the opinion, which is that, okay, I show you the fact that Warren Buffett 149 billion of cash, and then I tell you that Buffett thinks that the market is overvalued, right? And you should sell now. The second part is the part that you really need to be careful, because this is the opinion of the writer, right? So whether Buffett is thinking the market is overvalued or not, we don't know, right? Because that is the writer's opinion, not Buffett's opinion. And then the other part is that, okay, because market is overvalued, you might consider to de-risk, sell your stocks, buy when the market retreats. These are the stuff that opinions, you know, like even myself, we all do all these communications also, we tend to give opinions, right? I think this is good, I think this is bad. This is my opinion. You also have your opinions. Everyone is sharing the opinion. Just careful with the opinions, knowing that where the person come from, and then have your own opinion. I think that will be very, very good enough. But by reading news, I think for the fact, I think it's fine. And like Kelvin said, I think if you want to do a deep dive and get a very strong knowledge in certain industry, I think the industry news is definitely the way. If not, financial news is just a bit too surface and then have too much opinions that may not help. Yeah. So that's my take on that. Thanks a lot for all the comments. Yeah. Let's move on to the next one. Where are we? Okay. Do you think beginner investors should learn options trading or just buy and hold for capital gains? Wow, this is a good question. I'll pass first. See anyone got any view on this?
How much time you have? I mean, if you don't have a lot of time, then don't touch it lah. If you have time and you are interested to learn, then go ahead lah.
Others?
For me, I think that if you have very little capital, maybe options is a good way to enlarge your capital base so that you can then have like 7% compounding. It's not bad on a 100k, 500k, 1 million. But if you have 10k, maybe it's okay to lose the 10k because you will earn it back in the future. So options is a way to just get that very high risk, high reward kind of thing. But most of the people that I know that want to do options trading, they don't even know what are Greeks. Like what is delta, what is vega, what is theta, then they want to do option trading really. That's basically just gambling lah. So if you want to do it, you need to know what is your purpose and then need to know the stuff in order to do it well lah.
And also
Yeah.
how the 10k means to you.
Yeah, lah, correct lah. So I just giving like a illustration lah, like maybe thanking someone can earn it. If you're a student, basically you can maybe save it in the first year, second year of a job. But that's my point of view lah.
So from my experience, so a bit of context, I've invested for 13 years already. So just to say that, just from my experience, I did not do any options since from the start until last year. So I think it all depends on what you think, because if you have the time, you're willing to learn, you can of course do some of it. But for me, where I was working at the time, and then it was just too much, and it doesn't fit in with the time, so I did not do it. So it's not a yes or no or right or wrong question. It's just that you need to understand the risk involved and the time and effort that you need to have, lah. And it's also very short term thing, lah. And a lot of people they feel that, oh, I made this month, and then next month I didn't do well, and then because a lot of them do not do like very good record keeping. So in the end, sometimes I'm pretty sure come out almost the same also lah. There's not like a very big difference with just holding on to your investments.
Yeah, I think that's a good point. Record keeping is definitely a must for option trading. If not, you would just like, I made a good trades this week, and then you spend the money on good meals, and then whenever you lose money, then wow, lose so much money, then it's just so stressful, right? I mean, investing in this way. Yeah, I do agree that options is mostly used for short term strategy, and our group here is invest for the long term, right? So I would say, especially for beginners, the answer is no. You don't need to do this. Just a buy and hold will actually enough. Just a consistently buying, even ETF, right? ETF or companies that is strong fundamental over a long period of time, you will be fine. You can be generating good result without options trading. That's my answer. But for those who are interested, right? Let's say if you just want to be more active, it's like for you, betting on the direction is not enough. You want to bet on the volatility. You think that now the implied vol is high. You think that the volatility will drop. This kind of like very active kind of view, and then you just want to take advantage, right? You cannot do that using stocks. You can only do that using options, right? Then just learn, but spend more time learning definitely, and then keep a good track record. Review your performance over time, and then you will know whether it will work out for you. So if it doesn't work out, then just review and maybe just scrap this entire strategy is also fine. I don't think it's a must, the options. And definitely there's a lot more to learn just from the technical side of things, like what H mentioned, right, about all this delta, vega, like the movement of volatilities. These are not that straightforward, it takes a bit of time to learn. And I know that whenever we say, okay, what's the resources to learn options, right? I think the best one is that 3 hours options video, right? I get a bit worried when I share the video and then they say, I need to watch the 3 hours video. Then I'm a bit worried because that even that 3 hours to me is still very basic thing. So it's not easy. And I think worst things, right, for investing in general is that it's okay to lose money. Like even I do long-term investing, right? Stock market can drop, right? It's okay to lose money, but you need to know why, right? You need to know, like for example, like market drop, okay, yes, market is volatile. It's okay to have some drop in the share prices, right? Those are fine. At least you know what happened, right? But in the options, if you are not careful, right, you can lose money, and in the end, you don't know what happened. So I think that is a very, very big risk. You don't want to like in that situation, like after losing money, still don't know what happened and learn nothing, right? This is like the worst scenario in my opinion. Okay, let's move on to the next one. How many more? Wow, so many. I think many added new questions. Okay, let's move on. What is your recommendations for longing versus shorting a stock, like the proportion? Shorting, I don't know what is the meaning here. Does it mean that it is a naked short? If it is so, I would say don't short the stock, because it's very hard to say one, because you can get a short squeeze, those kind of things, right? So for me personally, I'll focus on long. Don't do the shorting. It's just too dangerous. I'll pass to for others. That's all comment from.
That some people may not understand that shorting a stock actually costs money, because you are actually borrowing and you have to pay the borrowing costs. And then if there's dividends or anything, you have to pay, So it's not as fun as it seems. And then there's a time factor to it somehow.
Yeah, the potential loss is unlimited. So just be careful. And another thing is that, if you long a stocks, right? Imagine that the stocks drop 10% and then drop 10% and then another 10%, right? But each 10% is actually lesser, because your exposure actually become lesser, right? Like you started from 10K, after 10% drop, you left with 9K, right? And then the next 10% become $900, is not 100. But if you are doing shorting, right, it actually compound one. Like from 10,000, if you short it, you just increase 10%, it become 11,000, right? And then the next 10%, right, is not 1,000 already, it's more than that already. So it exponentially up. And if you are doing shorting, your liability become exponentially up. That is very, very scary. This is applicable to if you are shorting naked call. It's the same thing. So just be careful on those. So short answer is that no shorting, just do long, 100%, 0%. I think that's good enough. Anyone have anything to add? If not, we just move on. Just stop me if you have anything to add. Next one, what do you think of vaccine stocks like Moderna, Novavax? They seem to be more volatile than Elon Musk talking about Shiba Inu. Okay, I haven't really do a very deep dive into this vaccine stocks, but based on my memory, I think companies like BioNTech, Moderna, I think they are making money now, given that their production of vaccines all ramped up already, right? Revenue looks high. The problem is always like what's next, right? Because we don't know like how sustainable is their sales, their earnings. Because this COVID thing, some say it is forever thing, but let's say if it is not forever and it taper off, right? Let's say 2 years later, things back to normal, everywhere is herd immunity, then how do you sustain the revenues and earnings forward, right? So I think for those who haven't, you can actually refer to the glove stocks in Malaysia. I think that's a good reference. But that one has another problem, which is the average selling price problem. But all in all, I would say that the key determinants of these companies is that when the revenues, when the all these vaccines will drop in terms of their sales and earnings. So as for myself, I don't have exposure. Anyone else have comment on this? Because I really don't have much.
Don't increase the difficulty in investing by going for biotech pharma stocks unless you are very, very familiar with the industry, or you can project when we'll have a next drug breakthrough, blockbuster drug, or next pandemic, and who can come up with the most effective vaccine / medicine for it or drug for it. Yeah, it's very hard to understand. Yeah, like Bunty say, very hard to ensure or have the sustainable earnings going forward. You cannot, very, very hard to predict. I mean, you can't predict basically. Yeah. So increase a lot of difficulty in terms of choosing the right company.
Yeah. Okay, move on next. Why YouTubers keep talking about market crash? I think I have answer for this. It's very simple, because whenever you browse through your YouTube, right, YouTube will keep recommending videos for you to watch, right? Whenever you see a shocking face, there's kind of very flat titles, right? People will click into it. So it is very effective in terms of drawing views. That's why people will keep talk about market crash. Even though I think often if you click into it and you just finish up the video, right, there isn't much content to talk about. Right? It's all about the same thing again and again, right? But still, it is very effective to draw views. That's why people are talking about it. Okay. Any correction for Tesla coming soon? Why is it so overvalued? I think this will be an entire call for these sections. Yeah, cannot go into that into details. But it's just like for my own take on this is that if you look at the Q3, right? Q3 result, it's actually very good in terms of their growth, in terms of their profit margin, and then their gigafactories in Germany also will be starting soon. And once it started, right, it's not just that, right? They will keep ramping up. So I think their growth in the next, let's say, 1 to 2 years is basically secured. So that's on the fundamental side. And with all these good results, right, for sure traders will be chasing. I won't be surprised if, let's say, Tesla dropped by 20% in the next 9 months, right? So all this is just price movement. I cannot comment on that. It's just that I just want to highlight that there are many people who say Tesla is overvalued. It's all hype. I would say, please don't pay too much attention to the narrative. Just go into the Tesla IR deck. Just look at the numbers yourself, and then come to the conclusion yourself. Don't listen so much on the narrative on both sides, because I saw the narrative on both sides can be very misleading. On one hand, people say this is all hype. This company is only worth $100 at most. This is one end. The other end is that, okay, Elon Musk is genius, is the best CEO. No one can beat him. That kind of like genius level kind of things, right? So I think on both ends it's too much narrative. Don't pay too much on that. Go into details like what Kelvin shared earlier, right? Go into those deep dive into each of their business segment and ask yourself whether this is a good company to invest or not. Any more to add on this? Kelvin, you can also add,
Yeah, I think definitely this is something I should add. Anyway, I'm not commenting on the correction because I also don't know. But I'm also interested to know, I know that a lot of people will say it's overvalued, but I'm also interested to know why this anonymous thinks it is overvalued, because overvaluation sometimes may mean that it is overvalued now, or is it overvalued in the future? So that is what I want to get from the context, because some people are thinking that, okay, I shouldn't be buying something now because I think now it is overvalued, which is perfectly fine. But some of them will think that it will grow into this valuation in the near future, and it will grow furthermore. So I should buy now. I feel that it's comfortable that I should buy now. So I just want to know the context from this person. Why do you think it's overvalued? Or is it just because everyone is shouting it's overvalued and then you think it's overvalued? And also I do agree with what Bunti has said, that there is definitely two sides of the coin for this stock or for this company, because this is like a totally it's a one of its kind. So there you definitely will have like the Uber bulls and then the Uber bears. So you have to make a stand for yourself, look into the business more, and make your own decision. So I have shared quite a bit in this group, so you need to scroll up a bit or find some search or whatever. And if you need any information, you can just ask around, and if I have time, I will just explain some whatever I can. And also, I think Darren Yong is also quite well versed in this, and he's more on the ground. He knows the situation quite well as well. So I just saying that you are not wrong to think it's overvalued, but just know your context. What do you mean by the overvaluation? So for a lot of bulls, they are not looking at the valuation now or looking backwards. They are more on the future potential. So some people may also say, wow, it's 1 trillion already. The most it can go 2 trillion. But think about, if you are in the market long enough, think about 2008, the mobile phone market, not the company, not Nokia, the market is only worth 200 billion at that time, But now you see, Apple is 10 times that market in one company. So you can see that there might be potential. I'm not saying Tesla will definitely grow into that potential, but there is a chance for that potential. So it's just that, are you willing to pay the price now for that chance of that potential? Or are you willing to sit aside first and then think about, should I wait for maybe a better price?
Yeah, I think I can comment a bit on this because just in the past few days, I had a conversations with another friend on this topic, and basically this is what the discussion goes. So I was saying that okay, if judging from the high growth rate, and then judging from the profit margin is also improving, right? Then if you just do a DCF, you actually can get a high intrinsic value, given that there's a increasing margin, increasing sales. But then the friend actually, he said, basically he's not convinced. I will just share his view here. So the first thing is that people will say Tesla is like the energy company plus AI company plus robotic company plus all sort of things, right? But just look at their revenue now, they are like 95% still an auto industry, right? So this is one thing. And then if you go down into the auto industry part, right? People are not convinced that this is a business that can generate margin. Like now, if you look at Ford, Toyota, these kind of companies, they have very thin margin, right? So I think the for those who are skeptical on this, right, they will just say the margin will not be there. And the company is still expanding. You still have a lot of capex. And then if you cannot just keep on increase the selling price and then get a decent margin, right? Then basically it's hard to earn money. And even if you earn money, it is very, very, very small. So I think those who say it is overvalued, mostly they are looking at this and benchmark it against traditional automakers. And that's why there's such skepticism. Yeah, I think that's all. I think better we go through the other question first, but Kevin, let's schedule another session, just talk about this, and I try to invite the friend to join the session or not, see whether he's interested or not. But generally, I don't think he's that interested to talk about Tesla. So I'll have to ask first. Let's move on to the next one, yeah. What is your threshold for risk tolerance? -15, -25%. Do you use stop loss? Okay, I'll go first. I don't use any stop loss for one. And then in terms of risk tolerance, I would just say now I'm like 100%, right? I mean, in terms of my liquid assets, they are all in my Interactive Broker account. So I don't have like, let's say like 50K, 100K outside cash, just buy when market crash, right? I don't have that kind of money. So even if market crash, I will just continue to buy at the speed that I'm buying now. So I don't know how to answer this risk tolerance. You have to quantify in to give a better picture. For example, what is my value at risk? Those kind of things, right? I think it's too much for today's discussion. So you roughly know my risk taking. That's my tolerance. I'm fine even if the market drop 50% or 60% in 1 year. I'm still fine. I don't need that money. So that's where my risk tolerance is. I'll pass around. See anyone want to comment on this, or if the person asking this question, you can also like elaborate a bit more whether I have answered your question. Okay, let's move on. How come Berkshire sliding? I think sideways, right? Sliding sideways and not going up. Lousy stock. I don't think they are lousy stocks. How to say? In general, if you look at Berkshire business, right, there are two big components. One is on the financial side, which means all the bank holdings plus their own insurance. All these are financials. In fact, I think Berkshire is labeled as a financial companies, right? In the financial sector. And then the other part, I think they also have some, let's say like the BNSF, all this industry that is not tech related, I would say. So if you take S&P 500, right, if you just take up those tech names, and basically what is left, right, and you benchmark against Berkshire, I think they are just, how to say, about the same. I don't expect there's huge difference between Berkshire versus S&P 500 excluding tech. So now there's so much excitement in tech, and then tech has been growing nicely. For sure, there's a lot of excitement, right? The price goes up, right? But if you look at the industry, right, they are not uniform. So, for example, like energy stock, now recently it went up a bit, but if let's say if you look at past 5 years return, right, I think all these energy stocks is still quite low. Financial also is not as good as tech for sure, lah. So I would say that it is mostly due to sector exposure. And then the next thing is that they are having a lot of cash in their position also, which means whenever the stock market going up, they will go up less because with so much cash buffer in the balance sheet, right? What it means is that it is like let's say like maybe like 60 or 70% beta kind of stock, you know. So if the market drop a lot, then you can also expect that Berkshire will drop less now, because whenever their share price drop to a cheap level, right, then they have so much cash to do all the buyback if Buffett want to do, right? So these stocks is not going to drop like 70%. I think it's almost impossible, just because of the amount of cash that they have. And then in terms of their businesses, right, it is still growing, still generating a lot of cash flow. So I think the business is solid. I am not worried on the fundamentals. It's just that if you hope for like excitement, right, I think it's very tough lah. In fact, if you just pay attention to the conversation in the group, right, you see people say that, okay, Buffett and Munger, these are dinosaurs, right? So why should you follow their tricks, right? Why should we listen to them? There are a lot of all these comments that just don't lead to excitement. So that's why I think that's why their stock price is flat now. For me, I am not concerned. You know, I have some exposure in Berkshire. I'm not concerned if I'm an investor. So I think their investor also are not concerned. You know, they attract specific kind of investor. So that's all comment from me. I know Eddie is investing in Berkshire. Want to give some comment? Or actually, this question come from you.
No. The question didn't come from me. But yeah, I'm a long-term investor in Berkshire. So
are you worried?
sorry.
Are you worried that their stock is sliding sideways or slightly? I don't know. And are you worried that this is a lousy
I'm
stock?
not worried, because you look at it from a long-term perspective.
Yeah. So see, this is very good example. I will tell you, right, Berkshire investor, yeah, most of them is like Eddie. So they don't even look at the share price, I think. That they don't monitor it on a daily basis.
Coca-Cola, IBM, all that. So it's like those stocks you just buy and just, forget about it for the next 10 years. It's just like your dimensional funds. You just buy and forget about it for the next 10, 20 years.
Sounds good. Okay, next one. If we can cover YCX, I don't think we have enough time to cover yours there. Or what's the preference? Should we go through? You see the questions keep coming. So we can leave some for the next session here, or should we move on to YCX? You want to share something, right?
I mean, it's up to
Yes.
you all. It's fine. I can always share some other time or whatever.
I would like to hear what YCX has.
Yeah,
to
then
say.
go to YCX first. This is too much. I can't finish all of this. We'll just leave for the next session. Yeah. Okay. Then I'll pass the floor to YCX.
I'm trying to. I can see.
Clear.
Yeah. Right. Okay. So, basically, it's the thing is that I tend to also follow what exactly is happening from a macro perspective and look at things from macro ways rather than just focus on the individual stock. So the thing about it is that now that there's the Build Back Better framework is actually finalized and more or less passed already. This actually, what I do is I actually look through it and roughly see what exactly is it about. because as you know, it's about $1.7 trillion. And this $1.7 trillion, where are they going to spend it on? And how are they going to take back the 1.7 trillion in the form of tax? So this is what I'll go through and what I think will be further ahead, what will happen lah. So these, a lot of it are just my own projections and personal opinions. So take that in mind. Yeah, okay. So Build Back Better framework. Spending wise, the key components I highlighted over here. The rest of the 0.6, 0.7 trillion that I didn't highlight is actually more of regarding like those welfare or home built homes programs though. So if you're interested in those, then you probably have to look at the you look through the framework yourself and draw your own conclusions on that. What I focus more on here is more towards the narrative I'm building, which is that childcare, preschool, home care, disability, healthcare, clean energy, tech, supply chain resilience. These are the keywords that keep appearing in their framework. And not only do they keep appearing, but they also put a lot of money to it. So you can see over here, this is the amount of money that they roughly allocate to these sectors. Okay, and this is how they intend to take back. So that means they will give out all this money, but this is how they'll take back the money. Okay, so the take back of the money, there's going to be 15% corporate minimum tax. There's going to be stock buyback tax. There's going to be corporate international reform. So roughly speaking, what all this is about is actually more continuation of the agenda that started in the Trump era. I mean, they don't call it America first anymore, but actually it's still America first lah. So these are all America first type of policies. So roughly it's about 800 billion that they are going to take back. So the important thing over here, I mean, stock buyback tax, you more or less know what this is about, which is that you do stock buybacks, they'll tax you on it. Corporate international reform, this one is more about like I'll go through in the next slide, and the 15% minimum tax I'll also go through in the next slide. So 15% minimum tax, this applies to companies that report more than 1 billion in profits annually for 3-year period. So the key thing to note here is that 3-year period just nice is the 1 year into the next administration, or rather just nice it starts in the next administration kind of thing. And you have to thank the, Kirsten Cinema for this. She's very good. Yeah. She protects all her corporate lobbies. So yeah, this is a very good thing. I mean, good from I mean, depends on what you are thinking about, whether you are a socialist or whatever, but this is good for like a corporate perspective. Okay. Then there's also tax credits for R&D, clean energy, and carry forward losses. That means this is if you invest in R&D, for if you are a CEO or CFO and you invest your company profits in R&D, clean energy, or you carry forward losses and stuff, right? You pay less tax, you get tax credits. Yeah, that kind of things. And then there's a penalty tax for foreign corporations in non-compliant countries. That means countries that do not agree with the 15% corporate minimum tax. This is how they ensure that as long as you do business in USA, you have to get tax. Yeah, that's what they do. And offshore jobs are penalized. It's quite complex the way they penalize it, but rest assured, if you are offshoring jobs, you are getting penalized. And this also leads to jobs back to USA and keep work from home possible, but corps still pay tax in other ways. So this is also part of the corporate international reform that they are pushing forward with all the laws and things. So understanding these two things together, I kind of think through what exactly will people in the executive level think about when they look through all these laws. And I mean, they look through all these new laws and taxing and whatever spending. And basically, this is what roughly the financial strategy will be. I mean, I don't go into more detail because it's not needed. But basically, you want to invest in supply chain, childcare, all these, because those are those whereby if you do so, the government will give you subsidies basically for doing it. And then you want to ensure your statements or all your accounting statements have less profit. and you want to ensure you have less stock buyback and you have less foreign jobs. So so what does that mean? That means that you want to move towards more high skill jobs, because then you want to have more financial engineering of delayed stock options, because remember there was a 3-year thing over here, this 3-year thing. So obviously if you can delay your profits to after the 3-year, you have at least 3 years to do more corporate lobbying to see whether you can get the profits back, claw back while you delay it. Yeah, so that's one way. And obviously you want to have more investments in all everything that's listed over here on the top. So this is the best strategy. Second best strategy will be invest in other things like securing commodities and supply, because this will ensure that you have this, you are still doing all this, okay, but you are not investing in all these. You can still invest in other stuff and secure your own supply chain and whatever things. So the opposite of the above box, which is you still invest in this, but you do not do high skill stuff. You decide to still hire low skill cheap labor and stuff. And obviously from the short term perspective, it is obviously better because it's cheap. But then you will face more and more political and social issues, because especially with low skill jobs, right? The people tend to unionize more, and then they'll strike, and then they'll ask for better pay, and they'll do all kinds of things, and then you have a lot of headcount, and with more headcount comes with more HR, and then more over the long term. If you go for low skill jobs, it's going to be expensive. So rest assured that every single company that if they have the surplus, they will want to move towards high skill jobs. And also the other thing is that the worst is that you don't do this and you don't do this, and you actually start to do market share competition and more offshore work to actually try to take advantage of the short term. Why I say is the worst is because number one, you are getting taxed more. Number two, so even if you gain the market share, right? If you are unable to keep the market share over the long term because you did not invest in the long term stuff, then you are going to lose out. So it's kind of like a balance whether how much you want to allocate towards market share competition and how much you want to allocate towards offshore work, because those are getting taxed and you are not getting any subsidy from it. Yeah, so this is the financial strategy basic that is going forward for the next at least 3 years based on the Build Back Better scheme. And when I talk about high skill jobs, right, this is what will actually happen. It's just that there will be more robotics, and more robotics in the sense that right now if you see the robotics, right, there's only focus on things like supply chain delivery, farms, healthcare. But then there's a lot of things like, I mean, healthcare wise, housework wise, manufacturing wise, a lot can still make use of more robotics and more, and to actually do more automation. But the issue is that with robotics, traditionally, right, when you do robotics, there is a high upfront capital cost and there's a high expertise cost. And that used to be okay, because once you do it, you can over the longer term you can offset your costs and factor that into your tax depreciation assets and factor that as that. But then the thing is that because everyone is doing it nowadays, right, all the companies are doing it, robotics, uh the stakes are way higher now, and what I call the business product cycle, it gets faster due to the higher competition. So your economies of scale, right, it starts to shrink, because you can spend high capital and high expertise costs to build up your robotics and things, but if your product is unable to compete due to like better products coming out, right, then all the money that you spend on the robotics to automate the things is just going to be wasted. Okay, so this will actually mean that there needs to be faster and better automation design. The design process for the automation will have to get faster, so that, and not only faster, it also has to get cheaper. And this leads to a pressure in which that people will want to design robots that are more multi-purpose and multi-function instead of like very simple robots whereby, oh, this robot only does one thing, or this entire supply chain, the robots in the factory, they only produce this thing, this part only does this part only does that, because it will move away from this. And because due to products getting yeah lah, as I said, there'll be newer and newer products and you have to compete. So what will happen with robotics is that the industry trends will be that AI will take a more central role. And for those who don't know what's the meaning of generalized AI, general intelligence, and specific intelligence, right? If I remember, that's the word. I can't remember. Yeah, but generalized intelligence means that the AI is able to learn and adapt along the way. That's what basically it means. So take for example, right, speech recognition. Speech recognition, it used to be very specific. That means the you record the sounds and then you hear and things like that. But nowadays the speech recognition AIs is more generalized, whereby they learn over time on how people speak, and they are able to discern words and do those kind of things. So that's one example. So more semi generalized AI will be used to actually govern this robotics. So you start to see more robots, right, that aren't just like do one specific thing only. The robots will actually be more autonomous, and they'll do more things. I mean, this is a gradual process. Then there's also going to be more simulation. The reason for simulation is because of the high capital cost and high expertise cost. Because if you want to do out all these generalized AI, there's a very high degree of error. And if you do things in the physical world, the high degree of error is actually, number one, it leads to a lot of you still need time to actually test it out physically. And then you still need to there's a lot of cost to physical testing as well. So more and more simulation will be taken place, because especially now it's possible to actually simulate physics, right, real physics inside the computer. That what will happen is that this robotics, the automation design, they will start to simulate more of it inside computers and test out, because in the computers you can just press fast forward button and test out your simulation to see if it works according to the physics inside. And then once you already iron out all the kinks ready, then you build up the physical things to to do this. And so this will actually lead to more agile and lean frameworks for automation design, because more things will be done on the software side, and only when it's a software side that's finalized, then you build it out. And of course, there's going to be more advanced sensors that's needed to actually capture real world conditions, to actually so that you can actually feed the data and continuously feed it inside the learning pipeline of your simulation. Yeah. So this is the industry trends that it will go towards. So I get on to stock picks. Stock picks itself is that these are the ones that are written over here lah. And basically, I'm quite sure on the first three. But basically, I do invest in the first three. Okay, the rest is just more of like hypotheses, and I'm observing them itself. On like what actually is going on with them. So first thing is that there's going to be Japan is actually the forefront leader in terms of robotics, especially for robotics that work more with human, and it's not just like one particular function kind of robotics, but they are also quite forefront in that lah. So these are the companies that are in this, and the bottom are those ETFs that are in that, which if you actually look through the ETFs, right, like just now you all mentioned about like what ARK ETFs are not doing well and things, right? But if you actually look through the ARK-Q and ARK-W ETFs and PRNT ETFs, right, you'll see that they're over time they're actually doing very well. Yeah. So I mean, they are starting to ramp up now from this year and last year itself already. Yeah, and then the Japanese stocks, if you look at these, some of them, their prices may not look nice, but take note that they actually have pretty high dividends. So that's one thing. That's why their prices may look low all the time, kind of. Yeah. So this is the trend. This is what I summarize as the trend that's going forward for the next 2 to 3 years, based on the Build Back Better framework that Biden administration has passed. And obviously, as I mentioned before, this is what it is, right? I believe that in the robotics area, the we are firmly now in the early adopters stage already. So there still is quite a lot of ways to go, right? To go into the early majority stage, and before it finally leads to the late majority and laggard stage. Yeah, so that's what it is. That's all.
在那个 invest for long term weekly chit chat session, we talk about getting into meal.
Sorry.
Hi, Kelvin here. I just want to add a bit on the simulation part because I have experience there. So I worked in Nokia and Continental in the mechanical simulations from 2008 until 2015. So I just want to say that you are very right in the sense that simulation will play a larger role. That being said, I just want everyone to understand that the simulations has a very high skill set needed, but the trend is actually going down towards the software being able to take over a lot of decisions moving forward. So what I've learned from the industry recently is that there was a very tedious task during my time where we need to clean up the meshes. So like if you do 3D, if you are in the 3D design, right, you need to do the meshes, the triangles and everything. But in simulations, we need to have the elements. So the mesh is one issue that it wasn't solved at that time due to maybe computing power and so on. But there's a trend now to actually do a lot of the manual work through AI, so they can actually prepare the model and create like simulation models by learning. So I think what YCX put here is really, really profound. And I think that it's worth to have a look into the companies that provide this service, because the trend is definitely going to less prototype builds, less physical builds, and faster manufacturing, like a lean manufacturing. So and in another sense, it's also talking about the Nvidia, right? During my time, we also use a lot of the GPUs to do simulations because it's more cut out for this kind of calculations, and instead of a generalized CPU. So I think that's also a very interesting thing to look into. In the simulation space, also it's going into the multi-physics. So it's really, really simulating real life as best as it could. During my time, it was more still we separate the physical domains to like thermal, we do thermal, mechanical, we do mechanical, you know, like antenna, we do antenna. It's quite what do you call that? Quite separated, you know, disciplines. But now it's also going to multi-physics, so it's really, really simulating the real physical world. And I think all this is helped by the fact that computing power is getting really immensely powerful, and I cannot say what is the performance like nowadays, but during my time when I simulate just the mechanical part, right, for a mobile phone to a dynamic impact when it drops on the floor, I needed for a accurate representation of all the components, and also an accurate and a reasonable time to finish it. I needed about 2 hours for one drop case using 64 GPUs at that time. So now I would say it will be definitely more powerful. So I don't know how much is needed, But I think the trend, you can see that more is needed as more physical domains are being simulated. So and I'm quite excited also in seeing that more products are can be done in the future with less manual input. So I think that's my take from the industry side.
Thank you, Calvin. Yeah, so basically the a lot of all these things is just it's going to be pushed forward by the financial strategy, because based on like it's basically the Build Back Better framework is basically just giving a lot of money, like 550 billion to 600 billion, and if you invest in certain things you get tax credits for it. So I can be quite sure that the CFOs, the CEOs, they will all be thinking, hey, let's just take this opportunity, right? Since we have, especially if we have the capability to do so, let's take this opportunity to actually do all these things and secure our futures. That's the kind of thinking that they'll go through lah. Yeah. And of course, the reason why I suggest these stock picks is because these will be the ones whom either are already doing it or they are selling the platforms to do it. Yeah. So obviously, in a gold rush, you want to sell the shovel, and these are the shovel sellers, basically. Yeah.
And for
Any other questions or opinions or things? Or what do you all think about all this? Yeah.
Maybe I also want to add, I forgot to add this. When during my time, a lot of companies, when they do simulations, they have to have a very high capex because they need to invest in the computing cluster and the hardware itself and also an IT team. But nowadays, everything is going to the software as a service. And there's also a trend where simulations are going to the AWS clusters and so on. So maybe capex will be reduced there also lah. So there's also the bear case there also. So just take it for just my opinion lah. Just to tell you that the trend is also going for smaller companies can also afford simulations instead of previously where only large companies can afford to do simulations.
Yeah, I agree. So that's why buy the shovel makers. Yeah. Yeah. Okay. Yeah. That's basically this. I hope it's a short and simple presentation. Yep.
Yeah, it's a great presentation. YCX, thanks a lot for the sharing.
Okay.
There's some echo,
Welcome.
but for those who's interested to know more on this, right, like the Nvidia Omniverse, right, I think the number one source is still go to the YouTube and check on the GTC. So I think the recent one, the most recent GTC is a lot better than the one before that. The one before that is a bit like high level, didn't go through a lot of all these details. But the most recent one, they talk a lot, like expand a lot more into like omniverse stuff, the auto industry, autonomous driving. So I think they are all, now you see like as a different stream, right? Like there's one stream for the autonomous driving, another one for robotic. But eventually all this, right, I think they will converge at some point now, because eventually they are all doing the same thing, right? It's all the machine learning, AI stuff. It's not that different. It's just that some of the platform, they for now at the start, right, they need to package it in such a way that easier for those who just get into this area. So that's why you see there's different stream. But I think ultimately they will converge for sure. And I think for now Nvidia is still leading, right, in this space. Because
Yeah,
even
I'd
for
like to add that the vision, right? The vision that I have, because right now what I shared over here is like the 2 or 3 year kind of things, right? But the vision is that, I mean, you can see with the Tesla board already, which is that it's still a concept, but rest assured that they are developing towards it. And what it means with the Tesla board is that all all your Terminator and whatever fantasies will all come true. So basically, there'll be Terminators, there'll be your robot waifus and whatever things. They'll all come true, and it'll no longer be like, oh, you have like a vacuum cleaner that's walking around in your house, that kind of thing. It'll be like you in the future, maybe 10, 20 years time, you probably will want to buy like a robot companion or whatever thing that actually does all your housework for you or whatever it is. It is going towards that trend, and the way forward is already mapped out in this way, because due to the fact that now the AI is actually getting more and more generalized rather than specific. Yeah.
Yeah. Actually, my vision on this, right? I think let's say don't talk about 10 years, let's say in 5 to 10 years time, because I don't have a car, so I go let's say like shopping for grocery. I just take my small trolley and then go to nearby Giant or SharePrice to buy stuff, right? And I look at the trolley, like I'm thinking like, how long would it take for that trolley to become autonomous? Like something just for me to put stuff in, and it will just follow me wherever I go, right? So I think this one will come sooner than, let's say, a robotic that clean the room in the house, because it's a lot more difficult. But just put on like I think it might be already in prototype mode, I guess, as of now. Like we have seen some video, right? Like the luggage at airport, the luggage is just follow you, right? I think it's already, with the technology that we have today, we already have that. So I think this will become more common down the road now. I don't think we need to wait that long. Probably in a few years' time, we'll see that. Yeah. And companies like Nvidia, I think they are good in terms of providing a good platform, and those platform is very hard to let's say replicated by others, because there's some network effect there also, because people who used to like this CUDA platform, right, they will stuck, right? And Nvidia is also not stopped there. They will keep on coming up with good software that help the developers in this area. So I think this is definitely something that will become a moat for the companies. That's why like these companies is good.
So that's
right,
why I just like to add one point. Going back to the original question about what overvaluation and like whatever crash correction kind of all those things. Basically, if you look at, I mean, what's the worst that can happen? A crash to say, let's say 50% crash, okay? 50% crash. So now 330, it drops to like $160. So if it drops to $160, but what are the odds that people will not buy back in, or if the fundamentals never change at all, like the people are still going to use this software. They are definitely going to subscribe to it or buy it or to do these things. Then why is there a worry that it will drop? Or if it drops, then you just think about it. Did the fundamentals change? If it never change and the outlook is still so good, then just buy. That's all.
Yeah, nice one. Okay, any other questions? If not, we will close soon. I think this already 12:10 now. Anyone else? All right. I think I will upload this to the YouTube as a like upload this video, because there's a couple of friends already asking me whether I will be uploading. So I will share this. Let's say if there's any part that you want me to take out, I can do that, but let me know soon. If not, we will have another session and go through the rest of the questions. I hope the Slido will keep these questions and will not delete it, but I will do a backup later. So, all right, then I think that's all for today's session. Thanks a lot for joining, and till the next time.
Thank you. Bye bye.
Okay, thanks a lot. Bye bye.